This is the More Doors podcast. We are here, episode 62.
All right.
With an amazing guest who recently just migrated to the Dallas-Fort Worth area. I'm here with an amazing squad around me. We'll be back with the show and our guest right after this. All right, everybody, we are back. Episode 62 of the More Doors podcast. My kids reminded me yesterday that it's less than 3 weeks before Santa comes. Kind of a scary thought.
How many times have you watched Love Actually so far?
What? Dude, what?
What?
Are you on the wrong show?
What? No, me neither. Only twice.
I thought you were going to say Christmas Vacation.
Yeah.
At least 20 or 30 times already. But
My wife hates that movie. Okay. And I'm trying to bring her around.
Is that why you watch as much as possible?
She doesn't enjoy movies that just come from a place of pure chaos and stress. It gives her anxiety when things are going wrong. And if you just look at that movie objectively, it's just 2 hours of stuff going wrong. So I love it. I'm going to have to put that on while she's sleeping or something. That's forbidden in our household. She likes the Hallmark stuff, which I love too.
Somebody keep the coffee away from this guy. What's up, gentlemen? Brian, Nick, what's happening?
Glad to be back.
Have you guys started your Christmas shopping? Be honest.
I have one person to Christmas shop for. That's the benefit of my family dynamic.
Uh-huh.
It's done.
Oh, nice.
It's on its way.
Okay.
It gets shipped to my parents' house.
Okay.
I do that every year. My wife does not do a good enough job of hiding what she's looking for from me. She doesn't realize that even if she orders something on Amazon and has it shipped somewhere else, and when you pull up Amazon, it's like, search for more stuff like the thing you were just looking for.
That's right.
So I at least get pretty close on what she's looking at. I do it through a whole different back channel.
Okay.
Yeah. I got favors I'm calling in.
Sneaky SOB.
I'm wearing black hoodies.
Really?
do you like giving gifts?
It's not my love language, but it's something that I find other people value. If it was up to me, I wouldn't give nor receive gifts. I would just bring joy into the world organically.
Should we make this weird and ask you what your love language is?
I forgot.
Liar.
Acts of service?
Words of affirmation is my love language.
Is it really?
I like a good pat on the back.
You're doing a great job, Ryan.
I appreciate it. Thank you, guys.
I sent you that gift yesterday. Like you.
Yeah. You like to give gifts, don't you?
I do.
Yeah.
I do.
Yep. I don't buy presents.
Really?
That's my deal. Gets me in trouble, but I don't buy them.
He just tells his kids to toughen up every Christmas.
No, I'm over there.
Your gift is reality.
It's a Knuckle Samo kid.
I'm sitting on the couch calculating how much my wife has spent on Christmas. And I was like, oof, this is a painful one. So,
Wow.
Yep.
Yeah. We've agreed to throttle back a little this year in light of the impending wedding in 6 or 7 months.
Oh, yeah, that's right.
We're saving.
That's the gift that keeps on giving.
That is. It will be. It's going to be a lot of fun.
Yeah.
Talk about our gift right here.
I know. We're about to introduce our live and in-studio guest. We haven't had one of those in a while. Before we do that, who wants to say a little note about our sponsors?
Our note about our sponsors. Some of the best in town. Check out deepbluere.com. That's the home of Deep Blue Capital. Go create your investor profile there. We got all sorts of cool educational content to help you on your investing journey. And sign up. You'll get early access to all of our upcoming investment opportunities. And then head on over to tourstudios.com, the home of Tour Studios, Tore Studios. And Jesse Showalter will hook you up with all your multimedia and content creation needs.
Nice. Well done. It's like you practiced that once or twice.
Never skipped a beat.
Unbelievable. You never cease to amaze me. See, there's some words of affirmation.
I'm having a great day, guys.
It's not even over yet. All right. Well, with that all being said, oh, by the way, before we segue, real quick. So I'm talking to Brandon the other day, my 10-year-old son, and we're like, we're trying to get Christmas lists together. What do you want to ask for Santa? I said, what do you want for Christmas? You know what he said? I want a Deep Blue Capital hat.
What?
That kid, I just love that kid.
Love that dude.
Unbelievable. I don't know if we have any kid sizes, but we'll figure something
The
out.
hat's awesome. I wear it every day.
I have I probably have a smaller head than your son, so if it fits me.
I'm glad you said that because I felt like I took a short jab at you a few episodes ago and I wasn't going to do it again.
I don't want to go down too far down a rabbit hole because I feel like I already have, but when I went to the World Series, I wanted to get a new World Series New Era hat, and I walked into the place, I was like, can I get a 7? And she looked at me like, those don't exist. She had to dig so far to find a 7. Like, if you're familiar with like New Era fitting hats, 7 it's the lowest adult size you can get. And even that was a little
Duly noted. You had a little extra wiggle room. Yeah. That's why you grew out the hair.
hair out.
Nice. All right. Well, let's introduce our guest. This guest has an amazing story to tell. Recently moved to DFW to get better handle on his investments here, growing some businesses, getting more active in the community. I know him from a mastermind community that we both belong to. And in the last 4 or 5 years of knowing him, just seen him absolutely explode into the scene. So without any further ado, let's introduce Vince Gethings to the show. What's up, Vince?
Good. Thanks for having me. I'm excited. I was just watching all the banter and enjoying it. Flying the wall.
Appreciate you coming on. I always feel bad about when we have guests because before we introduce them is when we do all our banter, and then we make them feel uncomfortable for participating. We should do our banter after we introduce guests.
Note to self. Note to self.
No, it's awesome. Thanks for having me. And this setup's great, and I'm excited to have the conversation today.
Awesome.
Absolutely, brother. So we always put our guests on the spot because I hate just like reading people's LinkedIn profiles on the air and all that type of stuff. So just give us the background. Tell us a little bit about you, about your organization, your journey. Would kind of get us up to speed.
Yeah, up to speed. So my story starts from the military. So I'm actually a veteran. I did 16 years active duty in the Air Force. During that time, just like a lot of other people, read the Little Purple Book somewhere around 2013. I was big into stock investing in that time and kind of doing swing trading because that's things you can do while you're deployed.
Sure.
And anywhere you can have an internet connection, you can trade stocks and everything like that. So I was big into that for a while during the first half of my career. Then I read The Rich Dad Poor Dad. 2013 got me into real estate investing. I did my first VA house hack. I was stationed in California at the time. So 2013 to 2016, sold that, and I think I made like 130 grand, and I was like, holy crap, like this is my future. Like everything else, like just, went out to the margins. I was like, everything's going to be about real estate from here on out. So I took the 130 grand, emptied my brokerage accounts, and started investing in real estate back in the Midwest. Got up to about 20 units in about 15, 18 months, all on my own, just going out, buying stuff. And at the time I was like, that's great because the education at the time, 2015, 2016, 2017, was pretty much like Bigger Pockets was the only one that I knew about. So they used to teach it just about like how to buy a single family, how to buy a duplex. So that's what I was out buying. So I got the 20 units, and then all that money was gone. It was deployed into those units. So I'm like, now what? How do I get that next level? And that was about 2017, 2018. And that's when I realized, I was like, well, these other guys are buying apartment buildings. How are they continuing to do that? Mm-hmm. So then I went back to the drawing board and started looking up these groups like these masterminds and things like joint ventures and syndications and funds and all that stuff. And I was like, oh, there's a whole world to get into that I need to learn about. So I just immersed myself in learning, joined a mastermind that I was talking about, consumed all of that. And very, very quickly, my next purchase from the 20 units was a joint venture 52 unit. And that was just people that I met in local meetups and local RIAs. At this time I was stationed in Hawaii, so I was even further, I was overseas buying these apartments. So if there's any excuses, it's not in my market, I was doing it from overseas. So if there's a will, there's a way. So my first joint venture was a 52 unit. That was the start of my company, Tri-City Equity Group. In the Midwest. And then from there, we got the taste of the larger multifamilies. And then that grew into a couple of JVs. And then that grew into, okay, what's next? And then there's like the syndications. So we've got up to about from 2018 to 2022, somewhere around 1,000 units. But then we made the decision to start scaling back significantly. And the reason was, at first we did a very rookie mistake. Is people go a mile wide. And that's what we did. We were like, well, if I'm overseas, I can hop on a plane and go to Dallas just as easy as I can go to Charlotte. So I'm looking for deals everywhere. So we scaled to that 1,000 units very quickly at the expense of, I became the bottleneck in the operation as the asset manager, because now, after a year or two, just buying, I'm like, all right, well, now I got 5 property management companies to manage, a dozen contracts, 5 different laws I have to know for different states, from Virginia to Tennessee to Maryland to North Carolina to Texas. I'm like, it became, I became the bottleneck and became too much to manage because we went a mile wide. So you can scale very fast going a mile wide, but you're gonna fall apart. So we, at 2022, we did our end of year traction meeting, EOS traction meeting. And it's the real deal. Yeah. So we do that in all of our companies, and we're like, all right, let's step back. What are we doing wrong? What's working? What's not? And we're like, well, DFW is the shining star of our portfolio. It's outperforming everything. It has the best metrics going forward for the next 5-10 years. So we're going to sell everything that is not this market. So that we started doing that in 2022. We only have about 2 assets left that are not in the Metroplex here. I ended up moving down here to even further that commitment. And then we're like, all right, what's next? And we're like, well, I want to control the entire value chain of our operation. So naturally, the next thing is go vertically integrated. And we started our own property management company last year, Black Sand Property Management, that manages the Tri-City Equity assets. And I'm here kind of just overseeing the teams and building those world-class teams that you were talking about. And, we're going to get back up to, so we're going down, we're going to get smaller to get bigger, smarter. Yeah. So we can go further as a team as this thing grows. So that kind of brings up to speed.
Yeah. Fantastic journey, man. That's a heck of a story. And also impeccable timing on having that meeting right in the end of 2022 and started to look, if you had kept that same mentality all through 2023 and earlier this year, we know a lot of people that kept that same scale at all cost mindset. And now the costs are starting to mount. Yeah. So a very emotionally mature way to approach your business. I want to jump back just for a second. When we talk about building that single family portfolio and utilizing a lot of bigger pockets knowledge and things like that, I assume were utilizing like a BRRRR strategy back then in the beginning?
Yes. Yep. I was doing your typical BRRRR strategy, local lender, business portfolio loans at the local credit unions and local banks. Yeah. Is what I was doing. And again, it works really well, but it was just slower than what I wanted. Mm-hmm. And it's what I want is relative to everybody's goal. So at first, give you more context on that 20 unit. So being in the military, and any military listeners can resonate with this, was we have our pension at 20 years. So my thought process was like, okay, well, your pension is going to give you X amount, and my living expenses are going to give, I just need an extra $4 or $5 grand a month. So that was my problem to solve. And I was like, all right, well, if I get my pension at 20 years, how can I get another $4,000 or $5,000 a month to maintain the quality of life that I'm enjoying now? And that's, back into like, 20 units, that's all I need. And then I got there, and then that bug was, fully seated. And I was like, that's not enough. I was like, I need more. The sky's the limits on this thing. So that's where that 20 unit came from. And I hit the goal, but it was too fast. So I was like, I didn't set my goal high enough. So then now we're,
that's awesome.
The next level.
What is that goal now?
My goal now is 20 million net worth with $1 million cash flow annually. But that's not just real estate. So I own a handful of service companies too. We can get into later, home service companies that kick off a lot more cash flow than the real estate does. But yeah, so 20 million net worth and $1 million annual cash flow.
And so as you're going through that, right? So you hit your 20 units fairly quickly, still in the military. What, at 16 years in, you have 4 years left to hit that. So you decided to eject from that. Is that? Yeah,
great pickup on that. So at the time, I was in a position that y'all probably won't know, but it was called a career assistant advisor, pretty much like a guidance counselor for the wing that I was in. So and a professional development coach. So kind of like think of that type of role for the entire wing. And that was a special duty. So I was 16 years, E7, Master Sergeant, and that job was ending. And then they're like, oh, okay, now you have to go back to your previous career field that I've been out of for 7 years, which was aircraft maintenance. And aircraft maintenance is a very tough life. You're on the road a lot, you're on the flight line a lot, 16-hour days, deployed a lot, and then I had at the time, Tri-City Equity Group was just starting to get traction. So I had the decision. I was like, all right, I'm either gonna, go in on the career, finish the 20 years, or I'm gonna give up the pension for life and see what I can make of myself of this Tri-City Equity thing, or see what my potential is. Being an analytical person, I not to make an emotional decision. I was like, all right, well, that pension's worth a between the time I retire at 38 to say 60 at whatever it is, $4 or $5 grand a month, add that up. It was like little over $1 million. I'm like, all right, I need to make $1 million. And that's the bet I'm making is I can make $1 million on myself faster than the Air Force can give it to me in the pension. The government can give it to me in the pension. And I did it in like 6 months. So I was like, after I pulled chocks from the Air Force. So it was a good bet on myself. Maybe, I'm not saying everybody do that. It was a very big bet, but I had confidence that I was like, I can do this. So it ended up working out. But that was kind of how I went about, rationalizing giving up 16 years of active duty service and that pension.
Yeah.
What do those little micro steps look like to help you feel confident that you could leave the Air Force and then pursue the recovery of that $1 million?
Really, so there was the $1 million, and then I was like, all right, so how many deals does that break down to? And when we talk about like, not just multifamily, but it was like, all right, I have different things in my tool belt that I can do. I have flip houses, I have my service-based companies, and then I have my multifamily either through the joint ventures, say we go buy a 10 or 20 unit, or we go do something big like a $15 million deal. And then, putting all those little things down there, I'm like a kind of like Tetris, and you're putting the puzzle together. I'm like, all right, well, if I just flip, 10 houses and 2 JVs and like 2 or 3 big syndications, I'm there. And that's a version of that is what ended up happening.
Yeah,
and that's
just
how
do that.
That's easy.
Yeah.
Simple. Maybe
I love
not
that
easy.
mindset.
Yeah,
though.
absolutely. Yeah. It's something that, I've picked up on something that you said, and you've been here for 45 minutes between getting here early and just now. But twice you've already said the problem I needed to solve is X, right? Where does that kind of problem solving and solution mindset come from? And like, how often do you find yourself applying it?
I'm not sure where it comes from. Maybe the military, because there's always like fires and crises, and you have to be like very specific. And
It's not like there's a big margin of error with aircraft maintenance.
Yeah, exactly. And it's like you just have to make the decision, stick to it, stay confident. So it's probably something to do with that. I can't think of anything specific, but as far as how often I apply it, every day. Like in my role as I'm the the owner or CEO of several companies, and then the asset manager for the portfolio. It's like every day I'm making the decisions, and it's trying to stay out of the process and just kind of look at it like a chessboard. And it's like just run scenarios through your head and just pick an action and just stick to it, or pick a course of action and just kind of stick to it and see what happens. If it fails, all right, great, not that way. Let's go the other way. So a lot of people get crippled in this space, or just really in life in general, about not being able to make a decision, and that just cripples them. I'm all about like, I got 70% of the information. I'm going to make a decision, and we're going to make the extra 30% up as we go. And make the decision. If it fails, great. That's one way not to make a light bulb. And let's go back and hit it again and go through those iterations as fast as possible. Yeah. That I actually got from Tom Bilyeu. I was at a mastermind, and he spoke about, obviously he's a lot of tech heavy, but he's like, the best companies in the world, they fail so much and so fast. That's why they have the best product, because they can go through iterations, 30, 40 iterations before company B even does one thing, because they're trying to make the perfect application. And then they spend all this time trying to make it perfect, and it ends up sucking, where the company that just put, minimum viable products out, like boom, 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 and then get data and keep hitting the iterations. He's like, that product will smoke anything else. So I did get that from him.
Nice.
That's,
I love that.
I mean, that's
I'm a big fan of Tom Bilyeu.
100%. I was going to say that. Your superpower seems to be something that a lot of people struggle with, and that is, you mentioned this when you did the example of, okay, I got to make $1 million in a certain period of time for this to be worth it. You have a superpower that is creating a perfect balance, or close to perfect balance, of the amount of fear that you should feel out of over any decision, right? We have a really bad ability as human beings to ascribe the right amount of fear to the danger of the situation, right? We act emotionally. Most people would go, I can't give up my pension. Like, that's my future, and not really give it a second thought, right? Like, it's just too scary. Most of what keeps us in a state of inaction is we don't take that step back, and we get into that analytical mode and go, what is the worst case scenario versus the best possible outcome? You can boil this down to many things, right? It's like, not approaching the girl that you're really attracted to, right? Like what fear stops you? The fear of rejection or embarrassment. Meaningless fear.
Yeah.
What is the potential outcome? Meeting the person you're going to spend the rest of your life with. We don't slow that down. Most people don't have that. That's like a very specific analytical brain. But if there's one action step you can take away from that, something that comes so naturally to somebody with a very analytical mind can be so powerful if you allow yourself to start to train your brain to take that step back and just kind of like rate that fear, rate the fear of the worst possible outcome and rate the fear of not having the best possible outcome, which is making $1 million in 6 months, apparently, right? Like that's something that comes very naturally to you that I think you probably almost gloss over as like a really valuable thing for other people to learn because not most people don't have that analytical way of thinking.
Yeah, you said it better.
I said it longer. I'm really good at saying it longer.
Most people run away from fear, right? And you know, 16, you are 80% of the way there to your pension, and running that is like, all right, you know, people take history, the time already involved is like, man, I've already done 16 years of this, 16 years of blood, sweat, tears, frustration, and then you're looking at the next 4. All I got to do is make the next 4, then I get my money like clockwork, and you know, they don't have enough confidence in themselves to say, hey, I can go make this in X amount of time. Right, where what you've done with multiple companies, what we've done is just rip the Band-Aid off and say, all right, you got to go in with both feet. If you're 99% in, you're 100% out. So it sounds like anything that you're doing, you're going to be 100% in. Is that correct?
Yep. And then without getting into trouble here, I guess, but the military it doesn't matter which branch, does a really good job of kind of putting blinders on people to have them think that this is their only way. This is their only option. It might be intentional, maybe it's not intentional, but being part of outside mastermind groups like we're part of, and I'm sure you guys are part of other ones. And the more I joined and more I saw, how successful entrepreneurs think and getting exposed to their lifestyles made that decision a lot easier. But a lot of militaries are a lot of those groups are very close knit, and their friends are military from their unit. They're everything. They're coworkers, and that's all they know. So it's very easy to not be able to even acknowledge that there is another path out there. So I was fortunate in being exposed to things outside the military.
Yeah, I think that it's kind of the difference between a fixed mindset and a growth mindset, right? Certain people will say, oh my God, $1 million, right? I can't lose $1 million. And then there's a separate group of folks that are like, how do I make that back? Right? And then it's after that, it's like, what are the micro steps? How confident am I in being able to go achieve that? There are certainly people, quoting Tom Bilyeu, right? Who brought that guy? Like Tom Bilyeu, he says, like, there's just people stuck in the matrix, right? I have my $60,000 or $75,000 a year job. I can't do anything else, right? This is what I know, and it's like you're asking the wrong. You're stating that in the form of a statement or a sentence, as opposed to a question, right? How do I know that a $75,000 a year job is all I'm capable of? Why do I think that, right? What would happen if I went to go apply for a job that had a salary 2x what I make now? Oh my God, what if I got that job?
Yeah.
Figure that shit out after the fact, right? Richard Branson says if somebody offers you a job that you don't think you're capable of, take it and go figure it out afterwards, right? There's always some level of tolerance and understanding when you make changes like that. And I think, Vince is just one of those guys that just continues to like see that coming over the horizon and asks himself, like, how do I solve that problem?
Vince, let me ask you this. If you didn't have a little bit of that taste of success beforehand, right? So you got to 20 doors really quick. Let's say that you had struggled to get to those 20 doors. It was happening, but you didn't achieve it in a really quick time frame. As you're analyzing these decisions, do you think you still would have left at that 16-year mark?
Not the 20 doors, but if the Tri-City, the company I started after the 20 doors, if that wasn't taking off and on a good trajectory of like, we're experiencing growth and I don't see any reason why this growth isn't going to continue, it probably would have made it a little harder. But then, there's also the personal aspect of that too, of that move that made it easier, which was, leaving that special duty where I was essentially, 9 to 5, home every night, and then going back to a job where like for sure going to be deployed. I got kids at home, and they don't. I was in this teaching gig for so long, they don't remember me what it was like while I was like on the flight line and deploying and going TDY all the time. So it would be like a shock back home because they don't know, Vince in that aspect, or Dad in that aspect of because that was all before they were born. So me going back to that, and it's like, oh yeah, I'm going to be gone for Korea for a year. Sorry, you can't come. And so that made that decision a lot easier. And then having that financial independence that I was able to build, for me, it was like, I can't not take this shot and see what I can do with this company.
Yeah. So not just that company though. So you have Tri-City.
Yep.
You've also built a few other companies at
Correct.
the same time. Take us through kind of that journey and how you keep yourself from spreading too thin.
Yep. So the first company that I started was called the Villainotics. That's what I do all my house flips through. So house flips, my own personal portfolio. I have about 100 units or so that I own 100% on my own. And that's all in that company. Then when I was getting out of the military, I have a friend and partner now that owns franchises. And he kind of gave me the scoop on franchises, and I kind of went down that road a little bit, opened a franchise. And the reason for that was if anybody has a little bit of real estate, they know that getting lending as a passive investor as your primary source of income is very, very hard. Banks don't like that all your money is just a passive income. They're going to be like, let me see a W-2. And to the point to where my employees will get approved to go buy a car or house before I will. And I've seen this happen. I was like, this is crazy town, but that's how the banking system works. So the first business I started was a home service company. It was a franchise. Part of it was I wanted to try it out. The other part of it was I can make myself president, CEO, whatever, get myself a W-2. And now if a bank asks if I'm trying to go buy a car, go get a house, I have a W-2. Yep. So that was the problem I needed to solve was how do I have active income if 90% of my income is passive? So I started the franchise, scaled that up to 12 territories. For a time, it was the biggest by territory in the country for that system. I've since scaled it back, with more market data, more experience in the home service. I scaled it back. We have 8 territories now, performing well. And then, so a home service company, I started another home service company, I acquired another home service company this year on a purchase, on an acquisition side in August. It's a flooring company. So I have a flooring company now as well. And then the property management company as well. And then I'm eyeing up another acquisition that I don't have yet.
Fantastic. So all that being said, I'm sure these guys got a lot of questions too, but I want to make sure I get this one in. There's so many philosophies around doing multiple ventures, and they all boil down to simple sayings. You can do anything you want, but not everything you want, go deep on one thing. And I don't believe that there's any absolute truth to any of those. There's nuance to a lot of it. A lot of it is aligning with the right people, using the same principles. What is your just general mindset on how do you perform well in multiple areas simultaneously without sacrificing quality and just the whole thing falling apart?
That is a very timely question because I'm actually going through.
It's like it's all falling apart right now.
No, it's not falling apart. I'm going through for what do you call it? I have a thesis that I'm testing in my companies and in myself of and kind of it's a weird kind of experiment that I'm literally going through real time. I had a 30-minute conversation with one of the guys that I'm in a mastermind with last night. Yeah. At that exact question. What I'm finding. So when I grew up, stock investing. Warren Buffett, Benjamin Graham, put all your eggs in one basket, go a mile deep, have that basket. And then I went to multifamily, and then we did a mile wide. It didn't work. So we're going a mile deep into Dallas. So in some aspects, going a mile deep into one thing is working out very well for me. Where I'm having this kind of test that I'm testing out and trying to see about other smart people, other people that are maybe 2 or 3 decades further along than me is when it comes to the home service companies, because I have 2 now and I'm going to buy another one, is getting to $1 million, easy. Getting to $2-3 million, not that hard. Going from the $5 to $10 million on a home service company is I don't know. There's like a ceiling there,
Really?
and it's an exerted effort to get to 5-10 million. That's why you see so many. I'm sure all of you all see the ads from like Brandon Dawson and all the Cody Sanchez like selling the mentorship. Layla Hamosi and Alex Hamosi. Like,
Yep.
you know, they're selling that coaching how to specifically for that niche of how to go from 5 to 10 or 10 to 20.
Yep.
Because those leaps that I'm realizing are much, much harder than anything I've done in the real estate aspect. So the thesis I have, or that I'm kind of testing in my own companies and myself, is like, would it be easier to just have 5 home service companies? And we can go down why home service companies in a little bit, but would it be easier to just have 5 home service companies that I pull a W-2 for $80,000 to $100,000 a year and cash flow to me another 100 to 200 grand a year? So there's my $1 million, right? Or try to go all in on one company, service company, and try to push that to 20 million.
Right.
I'm leaning toward the former, and right now in real time, because I have the companies and I'm trying to push one of my companies to that 5 million. And I'm like, this is a lot more effort than just buying another company and getting it stabilized at $2-3 million. Like just your typical, home service plumbing company or HVAC company or whatever. Like $2-3 million is easy, and that'll kick off $200K. No problem.
So is that a matter? Is the ceiling that you hit? Is that a function of new business generation? Is it a function of quality control? Like, it sounds like what you're saying, everything. So it sounds like what you're saying is you do take that principle of going a mile deep at the actual company level, meaning don't have one home service company that does all of these different things. Rather, you'd have 5 home services company that has specificity and go deep with every one of those.
Yeah, that is true.
Okay.
That's true. Yeah, and then it's just everything, because there's not a whole lot of similarities that running the real estate companies and running the home service companies, they're so very different. The way I interact with the employees and the teams, very different. The way I set goals and do all the things very differently. But yeah, that is one thing that I've noticed is that we hit that $2-3 million and it's just like a ceiling, and it's like everything needs to change to get to that. Like every system, every process, sometimes people need to change, because it came very clear with like my foreman, my managers. They might be good up to a certain revenue point, and then they were tapped out.
Sure.
And then it became, you said the CEO, and you're like, this guy, I got to swap him out. Like they're not there. Either they're not there commitment wise to go to the next level, or they're just not there competency wise. And I'm like, all right, if I want to get to 5, I got to swap him out and get to the next level. And I've done that, and it it works, but then it sucks. So then I'm like, so that's where I'm kind of at right now in my life. Check back in a year, and I might have solved this problem. And I'm like, yeah, that was stupid. But right now,
I'm on board with your thesis.
Yes.
I think that is my thesis on it. And, I've always said, and especially in like the real estate businesses, you start squeezing a lemon, right? And you can only get so much juice, and you're trying to get even more and more. When you can go over here, there's a fresh lemon right there. You can just pick it up and squeeze it. Now you've got 2 of them. So I think your thesis is spot on. I think we check back in a year and you're like, yeah, all right, it's 100% accurate.
And honestly, that's why I love doing the show like this. It becomes kind of a mastermind sometimes. I'd love to connect with you on this a little bit. We're learning the same lesson in real time. So we have, a maintenance and remodeling company that acts as a vertical of our property management company. And our thesis is like, it's all houses, it's all the same. So we'll just make the company do the maintenance for the management company, and we'll do maintenance for other management companies, which is fantastic base of revenue. And then where our real profits come from are our large remodel and construction projects. That'll be like the big chunks. We have learned that those are 2 totally different companies from a process and systems and personnel standpoint. And we're generating a lot of revenue and a lot of business, but the back end, we're still learning a lot, because we really should have started as 2 entirely separate entities up front. So now in real time, we're trying to pivot and go down 2 paths with individual kind of entities, because we can realize a lot of revenue from both, but doing both simultaneously with the same platform is proven to be very, very, very dense.
Yeah.
It's pretty tough.
I think too, it's number one, it's been very interesting to watch your journey, right? As you kind of come up under those milestones, if you will. But I think this falls back to something that I've spent a lot of time thinking about, had a lot of conversations about, especially in startup territory, right? And I think what you're both talking about is the evolution of a startup. When you start a company, or maybe acquire a small one, right? You're absolutely a startup, And typically you're very, very scrappy, right? And you hire people that you see the passion, the scrappiness, right? The hunger, they're willing to go out, they're willing to work the extra hours. But you get to a certain point in the company growth where that's not the type of employee that you need, right? You need someone with a little bit more refinement, a little bit more depth, right? A little
Like
bit
that scrappy hurts you in
right.
that next phase.
you need a playbook. And I think if you look at a lot of very successful tech companies, there are very few that have had a chief revenue officer that started with the company and was ultimately the CRO when they went public, right? There is a completely different personality profile for a CRO that goes from 1 to 10 million, 10 to 20 million, 20 to 50, and 50 to 100. And, you know, it's mind-boggling. But when you sit down and think about it, right, you need someone who can come in with the playbook to say, I know how to manage a customer base of 5 or 10,000 people, right? I know how to scale an organization from 50 sellers to 200 sellers because I have, you know, a Rolodex of first and second line managers that know what my expectations are, that know how to manage deals, that know how to develop customers. And it's easier for me to go to them, right? And pull them in and pay them more money than the last person because that return's gonna come in 2 or 3x, right? And much more quickly. And it's tough when you're a leader to recognize those things because I think we all have love for our people. We want them to like be the best. But I also think it's a conversation where it's like, listen, this is the direction of the company. I love you, but I don't necessarily think you can hang on with us through the next evolution of our growth. So like, here's the golden parachute. Go, here's a month heads up, right? Like, but I'm going to go bring in someone that I think is the right person on the bus. And that's one of the most difficult things to do because you don't want to like get in anybody's way or hold them back. But at the same time, you have a company to deliver.
Agreed, 100%. It's kind of that you need those people in the startup phase. It's that renegade mindset that just we're just going to get up and just build every day. And if stuff doesn't work, we'll change our approach and we'll keep going. Like you're never going to get off the ground if you don't have those people. But that's what the CRO example is so true. It's a great example because then you need to have somebody who's refined, who understands how to operate a company on a larger scale because your margin for error becomes much bigger as you scale. And so those people either need to grow with you or it's very difficult not to hit a ceiling. I feel like in my first sales business, that's where we ended up getting is like we grew that thing really, really, really quickly and hit a lot of amazing milestones. And then I ended up in a point where I had not become refined enough as a leader to really manage a business of that size really effectively. And the first sign of market volatility, I was like, I don't know what the I'm doing around here, and it was a fantastic learning lesson.
Nice.
I think a happy medium, like what we were talking about, is like that 3 to 5 that I'm testing out. It's a 3 to 5 million where my company is not, I guess, successor is not contingent on one person. That's where I'm trying to get, because that's the biggest thing about the startup phase is like, your lead sales guy leaves, you're smoked, right? Your GM leaves, you're smoked, or whatever it is. So it's like, how can I get all of these companies stable at the 3 to 5 million where our performance and our stability is not contingent on one person? If I can get there, and the reason I like home service companies is because they're like identical, like having 2 or 3 of them, and the process to create a dollar and your systems and process, your SOPs, everything, it's like they're almost identical. So it's like I have it now. I have the framework. I can just keep bolting this thing on. HVAC company done, plumbing company done, and just acquire them, put that package onto it, get them up to that 3 to 5 million, and put that playbook in place. So that's kind of where I'm at. But that's I just wanted to jump in with that piece there. Like the 3 to 5 million for me, I think would be good with everything I have going on with the real estate because that's my real passion. But with the asterisk of it can't be contingent on one person that you were talking about. Like,
I think that's key. At that level, that 3 to 5 million range, that still feels like you're running really efficient small teams. How do you avoid being too dependent on one person?
I don't know yet. So I'm still there. I'm still there. I'm figuring this out literally in real time. I think keeping focused on the home service companies, because then a lot of the back end can be absorbed. Like I have the same controller, the same bookkeeper, for all the companies.
Yep.
So she's so that team there, it's they see all that. So that's like boom, that's one person removed.
Right.
Next would be maybe like a COO over all of the companies, and then that way they they can operate the companies as the COO. And then almost as each company has like a division under.
Right.
under
Yeah, that's what I was going to say is like really the company is actually the service company that builds the platform for the home services companies to plug into. So as long as you keep that team intact,
Yes,
the
back
service
office,
companies can come and go and you'll just plug and play.
So that's where I see this morphing into, and how to get to that. How can we not be contingent on any one person for the performance of that company? And then also having multiple companies that have different seasonalities really help, because when one service company is in their low season, well, what's during the high season or in that
Nobody's
time,
making
right?
money off HVACs right now.
Yeah.
It's like, in Texas, it's 60 degrees outside.
Yep, exactly. So what is making money right now? All right, well, that's the one we need to add.
Yeah.
So that's kind of the way I'm thinking about it.
So at what point in your evolution, Vince, did you decide that you wanted to do both real estate and acquire businesses? Like typically, I think the traditional school of thought is do one thing really well, right? How do you at what point did you like realize one day like you're capable of this?
When my partner showed me how much money he was making off of his companies, the cash flow wise, it's just like, and I was like, wow, that's
good answer I've ever heard in my life. I love it.
and
Was
don't
his name Nick Good by any chance?
and don't get me wrong, real estate is my passion, and that is the end all where all this cash flow goes. So our strategy, and my partner, we share the exact same thing, is how can we generate, what businesses generate the most cash flow with the least amount of time, and that surplus cash flow goes into buying apartments. And that's all we do, is just more businesses for more cash flow is more apartments, and we just scale that way. So that's what we're doing. But yeah, that's what brought me to the companies versus the real estate, was just the cash flow is, if you can get it right, I don't see real estate touching it.
So 2 questions. How many hours a week do you work? And then what's that pie chart look like on real estate and services businesses?
I work a lot. I don't keep a log of it, but I'm kind of, I don't
50,
know, probably
60.
I was going to say probably 50, 60. I'm trying to pull it back, especially now being in here in Texas. My kids play travel soccer. It's really important to me. So they're all at that ages, 12, 10, 8, where it's like these are the years that you can't miss, because this is their formative years. Everybody remembers the trials and tribulations of these years. Most of their morals and ethics and values and viewpoint of life were made during this period of life, that 10 to 16 range. So I'm like, all right, I got one shot. I don't want to mess this up.
I hear you.
So I'm really making an exerted effort to be there for that. But there's no days off in entrepreneurship. So Sunday, if I got to go to a meeting, it is what it is. My family's supportive of that. They're involved. They're involved in meetings. If we go on vacation, they know that it's going to be a work vacation. Sure, I can do 3 weeks in Italy, but we're going to have good Wi-Fi. If I have to bring that, stupid little satellite thing, Starlink, that's how we're going to be able to do, 2 months in Hawaii or, whatever, is because I can do my meetings and run my companies from anywhere.
Yeah.
So that's where we're going with that. It's been working out very well.
Awesome.
So. Yeah, fantastic. I want to come back to Tri-City just for a second. You guys have a thesis. It seems like your real buy boxes, 50 to 150 range here in the North Texas area. You aren't from here originally, even relocated to this area. What's got you so bullish on that market and that size and scope? What's kind of, take us a little deeper into your investment thesis?
So our buy box is 100 to 200.
Okay.
And it was for a very long time. It probably still says on our website 50 to 150. But what I've learned is the smaller sub 100 units in DFW don't really work for us, which is weird because that's what we cut our teeth on. That's where we were able to go in and really get some really good cost basis when we were starting Tri-City and going, either the Midwest or the East Coast, those 50 to 100 unit properties. There's not a whole lot of competition on them. The bigger teams, firms aren't really interested in those. So we were able to just go in, grab good deals, operate them really efficiently with kind of remote hybrid property management systems. That's not working here for us. So we had to adapt big time. If we were going to go all in on Dallas, and part of that adaptation was we had to draw a line in the sand, and the line was if a property can't support full-time on-site payroll, we're not interested. And that is just for the Dallas market. Like we were absolutely crushed it in other markets with 40 units, 50 units, 60 units. For some reason, we just can't figure out how to get those properties to run efficiently here. And I'm sure other people can, but it's just not working for us. So our buy box is 100 units plus or more or less when I'm underwriting, can it support full-size on-site team or not, rather than just a unit count. We're moving in this part of the market cycle, we're moving away from the C-class deals and we're going higher end. So B plus, A minus, we're under contract now on a 2021 build, $28 million. Because that's the cap rate compression.
I was literally about to say.
Yeah. All right. Sorry.
No.
Yeah,
It's your cost per door between C and B plus right now. It's like
and the effort,
pennies.
right? The effort to take that C class and reposition it and do your whole value add and all the things. And it's like, in the cap rate, I'm like, I can just spend another 10 grand a door and get this thing built 2 decades newer, not have the plumbing, not have the HVAC, not have any of that crap. And and then just focus on the next acquisition. So that's kind of where we're at on, in our market here. And then we were talking, before the show with the whole, I think it was like a bank crisis in the 90s, created a big gap in inventory. So it's making it a lot harder to find deals that fit that buy box. But we're in the streets. We're every day.
Sure.
We're grinding.
Yeah.
So
There's no reason to force it. We talked about a little bit before the show, right? Like market cycles are going to give you organic, parts of like bountiful parts of the cycle, right? Like, that you're going to do bad deals when you're trying to force them. You know what I mean? And so if there's just no deal flow and you're doing everything in your processes to find and create deal flow, and it's not happening in the amount that you want it to, you probably know you're getting outside of your lane if you're really trying to force it a little bit. You just need to be prepared and do the other parts of your business that are really, really meaningful in the absence of all that deal flow, right? Work on your brand, work on your systems, work on your processes, work on your networking, build your relationships so that you're ready for the next, Jubilee. You like that word?
I do.
But I feel a lot of people feel that way right now about the lack of deal flow. It's not singular to one group.
Agreed. So, question for you. So, before the show, we were talking about how this deal that you're working on right now, the raise is 2 to 2.5x bigger than the ones that you had done before, right? I see a lot of syndicators, right, out there raising money on social media, right? We've heard a number of folks on the show and kind of private conversations about it being more difficult to raise money in this environment, right? You're like, the hell with that. We're gonna go do a raise twice as big as we've done before. Like, what are the steps that you took to build that confidence, and what's it been real time on the front lines trying to raise almost $10 million for your latest deal?
Well, for the confidence, our team is and we haven't failed a raise yet. So like, hey, we're just gonna. That's one thing that me and my partner Duran, it's like, just tie those bootstraps on. We're gonna get it. Like, we're not sleeping until we get this done. So that's kind of the mentality that we attack that with. He's also military as well, 20-year Army guy. But so it's very much like there's no failing. Like, we're gonna get this done. Kind of mentality. For the size of the raise, it was bigger. It's kind of interesting of how our investor, we look at our investor base, of current investor base, trying to attract new capital, and what their appetite is and what they're looking for has changed. And it's not really going in one direction or another. We have some people that are sitting on the sidelines because they want to see how the market goes and whatever. We have some people that are really stuck in the C-class space, and they're like, we just want to invest in C-class value add, and we don't want to do the A-class. But then what's really worked out for us is because we were doing the C-class stuff, we've had a bunch of investors that were more wealthy, can stroke bigger checks, savvier, investors that didn't want to do the C class, and they've been waiting for us to grow to a point where we were buying higher quality product, those trophy assets that they can show their buddies at the country club and whatever that, and those have outweighed the people that may be putting in less or sitting this one out because they want to do the C class stuff and they don't want to do the A class stuff because it's perceived of lower returns. But that's kind of where overall I would say that we've had more investors putting in bigger amounts on this deal because they understand, because they're savvier investors and they understand that our cost basis is good. This is a core asset in a growing market in DFW. The metrics are there. We're getting at a discount for replacement costs of being only 2021, a 20-30% discount from where this thing would have traded even a year or two ago. So it's really good, and they're willing to put more in and sit this one in with a long term for the growth because they understand. And then, like I said, we've had a lot of people waiting for us to buy nicer quality product, more than the people that are sitting out this one because it's not the C class. So it's kind of all over the place, but I would say that's probably the overall trend is fewer investors, bigger checks for the people waiting for us to get up to that, their level, I guess.
That makes sense. I've heard, I think I saw an article recently, I forget who it was from, about returns on A-class product right now, stabilized A-class, just as a benchmark being higher than C-class or workforce housing.
Yes. And then that's what we were talking about. And so soapbox here, because then trying to educate the investors and stuff like that. But there's like a stigma or something like, oh well, it's A class and it's going to be no cash flow and low returns and all this stuff. But I'm like, but if you look at it side by side, the A class is right now because that cap rate expansion on there for this market cycle. I'm like, yeah, it might be a little bit more per door. But the upside on the A class and the security and the extra money capex we don't have to put into it, like this is going to smoke this C class at such lower risk adjusted returns. But some people see it and some people don't. And the people that don't, it's just like they're just stuck in their mindset of C class value add, forced appreciation. I'm like, I'm going this route every day. Every time I see a deal that hits this, because we're still hitting a 2x equity multiple on an A class, and they're like, yeah, but it's A class. I was like, and we want to do C class and value add and do all the, all the stuff. I'm like,
yeah, you just use
sense.
the key phrase, risk adjusted return, right?
Yeah.
And with the compression of rate or cap rates, like every dollar you pay over what really should be market value for a C class asset, you're just eating into your returns because your capex per door is going to be so much higher. So if you're getting a 2x on class A and you're projecting even a 2x or 2.3x on class C, you've got to underwrite your risk adjusted return because it's really easy for that class C to go from a 2.3 to a 1.8 if you run into a whole bunch of stuff over the next 5 years that you weren't foreseeing, right? It's when the return multiple or the equity multiple is that close, I would take the nicer asset every single time, and we seem to have lost that in this market a little bit.
Yeah. Agreed.
and being the asset manager, like we got to ones do the lift. So it's like,
it's
like
your hours.
That's a lot more time to reposition a C class than an A class where we just got to make it, keep it looking pretty.
Yep. So I think we're coming up on time here soon, but before we do that, Vince, we were talking before the show, and it's something that the three of us have kicked around as recently as yesterday, right? There seems to be a lot of talk in the market lately about folks looking to raise money, and maybe the syndication pools of capital have dried up for whatever reason, and let's go to PE firms and let's go to family offices, and they're going to stroke bigger checks and they're going to make your raises easier. And I'm sure there's some truth to that, but I think you had some pretty unique thoughts about some things to be aware of if you're going to go pursue those types of sources of capital.
Yeah, absolutely. And I'm still raising, so just so I am still raising on as a syndicator on that deal. But so I am in that bucket. We have pursued the PE or the family offices and those types of sources of capital to kind of, as we're building our capital stacks of how can we make this the most efficient and juice the returns the best for our the other investors and us, obviously. And every time we sat at the table with the family offices or the REIT types and things like that, or the PEs. I didn't like the way the conversation went. And some of them were very candidly of like, hey, don't come, yes, I can stroke you a $10 million check, but it's going to come with strings attached. This money it's going to be, very, very expensive money to purchase. So like exhaust all measures before you come to this table here. Cause essentially, you're hiring a boss, and that's how all those conversations kind of had the undertone of, I might be the lead GP, I might be this, but I work for them now. I have to answer to them, and they will frame it something like, oh, we're just strategic advisors and things like that. But then they're like, the undertone of the conversation went to like, you're going to have to ask us permission to do stuff. And we have, written into all the contracts and everything with lawyers that are more expensive than yours, that if there's any type of performance, variances or anything we don't like, we can yank you, or lower your hurdles and things like that for your compensation if something didn't hit. So I didn't really like that. They also, a lot of them will cap the structure of the deal. So sometimes normal syndication might be 70-30. They might say, hey, if you want to work with us, we're 85-15, we're 80-20. And that's all you're going to get. And then we cap your ACT fee, we cap your asset management fees. And then, so I kind of didn't like them dictating, my plate, what's on my plate. And then the other one was, what was it? It got strings attached, stuff like that, the capping. And then, I don't remember, there was something else, but either way, I just didn't really like where kind of the conversations go. Oh, it's very expensive. So they have the, your points up front that you pay them, then they have pref, and then they have this other accrued pref. They have ways of kind of putting their fees, sprinkling them in where it's coming from out of the cash flows. And once we sat down and underwrite it and spread out, I was like, man, to get this check, they're going to get a 16% pref. I was like, do you guys know what that means? We're pretty much working for free or very, very little for the next 5 years, hoping for the windfall at the end that they control. So over that, I'm not saying bad about it. There's a use for it. Obviously, there's a huge market for this type of money. But for me, where I'm at with where our company is, we still have, we still raise money. We still have, we haven't exhausted all those measures yet. But it's not all sunshines and rainbows where investors think, oh, I'm going to get that private office money and they're going to stroke a check for $5 million and all my problems are going to be solved. It's definitely not that.
Got it.
A little bit more complicated than that.
Yeah.
No, it makes perfect sense. Well, I want to be respectful of time, man. This has been a phenomenal conversation. We truly appreciate you taking the time. Where can people connect with you? Where can people learn more about Tri-City, all the home services companies? Where can people hit you up?
Yep. I think the easiest would be the social medias, Facebook, Instagram. I'm on LinkedIn. I don't think a whole lot of people check LinkedIn, but I'm there. So if you message me, connect with me, I'm on there as well. And then we have our websites like tricityequitygroup.com and things like that, and my website. So the social media I think would be a great start. Follow me, reach out if you want to see what we're doing, especially if you're in Dallas, Fort Worth, and you want to do a bus tour and say, hey, Leo, let me walk a property and see what it's like a day in the life of an operator. I'd love to meet you.
Love it. Excellent, man. Vince, really appreciate the time. Definitely going to have you back on, hopefully, if you're willing. Appreciate the conversation, everybody. Boys, last words. We got your sponsors again at the end. Final thoughts. I tend to cut you off before you have final thoughts. I can see your brain always turning when I'm trying to wrap it up.
You know me too well. Now I'm at a little bit of awe. 10 years ago, Vince made a hard decision, right? And now he's got 1,000 doors, a bunch of businesses, and apparently some immense clarity on where he wants to go next, right? And I just thanks for coming on the show, Vince. This is awesome.
Yeah, been fantastic, man. Make sure you check out deepbluere.com, the home of Deep Blue Capital. Create your investor profile over there. Head on over to tourstudios.com for all your content creation needs. Episode 62, boys. Got to get another one in before Christmas.
Now we got two more. Up.
Oh, fantastic.
We're booking January.
All right.
I got to go home and do some Christmas shopping.
Fantastic.
Not me.
No.
Appreciate the time, everybody. We'll see you next time.
Thanks, everybody.